Imagine waking up one morning and realizing the entire foundation of the US stock market is built on cracking concrete. Not the stocks you see every day, but the financing system underneath them. Most people never see the cracks until it's too late, but Wall Street often does. Welcome to Finance Flicks Hub, where we break down complex money news into clear, actionable lessons. Today we're exploring a warning that didn't make the evening headlines, but absolutely should have, because it affects every American investor. Let's dive in. 1. Goldman Sachs sounds the alarm. The venerable investment bank Goldman Sachs has issued an alert, though quietly, to its institutional clients, not in primetime media. The core of the message: it's not the flashy AI stocks you need to worry about. It's the credit and financing structure behind them that's showing signs of stress. They identify a $1.5 trillion funding gap just to build the infrastructure for the AI boom, and the institutions meant to fill that gap are under pressure. 2. A massive problem under the hood. We're in the middle of an AI revolution. Names like Nvidia, Microsoft, Google LLC, Meta. Platforms dominate the headlines. But Goldman's warning flips the lens. The real danger lies behind the scenes, in the credit markets fueling this growth. If the financing engine falters, the state-of-the-art tech doesn't magically fix it. 3. The Delta One Desk warning. On November 19th, the head of Goldman's Delta One Desk, the group that monitors real-time flows and structured derivative products, issued a frank note. The tickers he referenced tell the story: ORCL, Oracle, and Nvidia, well known in the AI space. OBUL, Blue Owl Capital, a major private credit player. COF, Capital One Financial, a big name in consumer finance translation. You may be watching the AI penthouse, but the foundation is slipping. And the names spotlighted are not the AI names, they're the lenders. 4. Why Blue Owl and Capital One matter? Here are the stakes. Blue Owl recently blocked redemptions on a $1.8 billion fund, warning investors they may face 20% losses. The private credit sector overall is reported down roughly 6 to 9% this year, with some deeper pockets being worse. In consumer finance, defaults and charge-offs are rising fast. Auto loan delinquencies are climbing. Credit card debt is at record levels. When everyday consumers struggle to borrow or repay, the entire cycle slows. The lenders who were supposed to pump the gas on AI infrastructure are showing signs of being unable to drive. 5. The AI funding problem nobody sees coming. Here's the math. AI infrastructure build-out, data centers, chips, servers, cooling, power, is projected at $2.9 trillion by 2028. Big tech firms, Microsoft, Google, Meta, Amazon, can self-fund around $1.4 trillion. That leaves a gap of $1.5 trillion. Who funds that? Private credit finance, loans, structured debt. But that very market is under stress. For instance, Meta already drew $29 billion of private credit funding for data centers. So we're already dependent on that funding chain. If the chain weakens, the boom can stall. 6. Market update. What's happening now? Here are key recent market signals you should know. Recent bankruptcies, e.g., in auto parts supplier First Brands Group and subprime auto lender Tricolor Finance, have triggered sharp outflows from U.S. loan funds, $1.5 billion of outflows in October from certain loan fund ETFs, and raised concerns about underwriting standards in private credit. The private credit default rate, senior unitranche loans, tracked by Proskauer Rose LLP, rose to 1.84% in Q3 2025, from 1.6% in Q2. Still low historically, but showing movement. Lenders are already tightening terms, more strength in contract covenants, more structural protection in deals. One commentator noted, lenders are quietly preparing for distress ahead of time. Despite these warnings, some credit metrics remain benign. Corporate debt service ratios remain well below the 2008 levels, and many analysts believe current troubles are idiosyncratic rather than systemic. In short, the warning lights are flashing. Not yet full-blown red, but definitely yellow. The system shows resilience, but the signals are worth noting. 7. Implications. What happens if funding cracks? Think of the AI boom as a luxury high-rise. Everyone wants the penthouse view, Nvidia, Microsoft, the flashy names. But the foundation is the credit markets and infrastructure financing. If that foundation cracks, the building becomes vulnerable. Here's what could happen if the credit chain weakens. AI infrastructure build-outs slow or pause. Chip demand weakens, data center expansion stalls. The entire growth narrative of AI gets dragged into financing delays. Tech valuations may suffer, not because the tech fails, but because execution becomes harder. Goldman is warning this is not a speculative concern, it's structural. 8. Goldman's market outlook. Goldman's CEO forecasts a possible 10–20% correction in the US equity market over the next couple of years. If the S&P falls 10 to 20%, tech stocks, which are heavily concentrated, could drop significantly more. On the returns front, the past decade gave us 13% annual average stock market returns. Goldman now projects 3%, 6.5% annually going forward. Also noteworthy, bonds, once ignored, may outperform stocks in this new regime given higher interest rates. 9. What smart money is doing. Here's how sophisticated investors are positioning. Increasing exposure to bonds and cash. Reducing overexposure to highly levered tech names and credit-sensitive sectors. Waiting for the correction to deploy capital rather than chase the peak. They're not panicking, they're preparing. 10. How retail investors usually react and how to do better. What often happens? Wall Street gets early warnings. Market stress hits. Retail sells at the worst time, bottom of the cycle. Institutions recover, get the bailout, or come out stronger. You don't want to be last in. You want to be positioned ahead of the stress. 11. How individuals can position themselves. Smart ways to navigate. Avoid being overloaded in AI hype stocks. Be cautious with exposure to consumer finance and private credit-sensitive companies. Maintain some cash reserves. Consider high-quality bonds, dividend stocks, defensive sectors. Stay flexible and ready to act when the next market move materializes. The goal: don't be caught off guard. Prepare so that when the cycle shifts, you're buying rather than scrambling. 12. History shows the opportunity. After the 2009 crash, bank stocks returned 10x for those who bought early. In 2020's downturn, investors buying quality firms at 30 or 40% discounts doubled or tripled their money. Opportunity doesn't always show up in bull markets. It appears during the downturns. Being prepared makes the difference. Ending. This isn't about doom. It's about awareness. Goldman Sachs isn't saying AI fails. They're saying the financing for AI may hit turbulence. And now you understand more of the plumbing behind the headline names. Stay informed, stay calm, stay ready. Because the investors who understand how the system actually works, not just the hype, are the ones who win. Thanks for watching Finance Flicks Hub. If you found this useful, make sure you subscribe so you won't miss the next deep dive into what really moves markets. See you next time.